Let's bring in Bill Simon, former Walmart U.S. CEO, now on the Darden and Haynes brands boards. Bill, it's great to have you. We were just talking about Nordstrom tonight, echoing Macy's on these comments about delinquencies. You think the consumer is really in three different persons right now, right?
I do. There's, the high-end consumer who's probably the most confused at this point. The middle consumer who is also struggling to deal with pretty high inflation, and then the lower end consumer who always is fighting sort of hand over fist to find a way to survive. And I think the high end right now, and you're seeing it in names like Nordstrom, they're just choosing to stay home. I think there's a real cautionary tone in that consumer where they're spending their money. It's on needs and not wants, and it's in trade downs as opposed to stretch ups.
What does that consumer say when they're told that their real wages are inflecting positive?
Yeah, I think what they're told and what they feel are two different things. I think that there's a broad fear that inflationary pressures are going to continue. We saw the American Airlines pilots get a huge increase this week, and that's on top of the UPS drivers who got a huge increase last month. And so we see wage pressure continue to push up. That, along with full employment, means we're going to continue to see inflationary pressure. And I think the high-end consumer then, sort of interprets that as, continued interest rate pressures from the Fed.
Let's go to the other side of the coin. I mean, when you hear the Dollar General's at a multi-year low, Dollar Tree, these are typically stocks that hold up in this environment, and they're trading awful. More importantly, the commentary is worse. Does that mean anything?
It does. And if you look at Dollar Tree and tear that apart, they actually had reasonably good growth on the top line. But because of their shift that they're seeing into their consumable business, again, which is needs and not wants, that's a lower margin product, and it puts pressure on their margins, and it's really hammering their bottom line. And they're seeing that continue. They also cited shrink along with Target and Dick's and several others. So, it's rough going out there. And we've really not seen this combination of high inflation and, recessionary threat in the past. And I think that's what's driving it.
Bill, I'm curious to know what you make of all the shrink discussion. Some argue it's an easy way, like the weather, for retailers to hide their mistakes. Is it overstated, understated?
Probably both of those. You're probably both right. It is sort of the excuse du jour. Once somebody cites it, everybody else goes, yeah, we're feeling it too. And I sort of feel like that. But if you really just think about how much 3% shrink at Target is, or even Dick's, that's like train loads, multiple train loads of product just disappearing. And it's hard to imagine that is just poor management. And so I do think that there's an increase in sort of organized retail theft out there. We've seen it. We've seen the pictures of it. Retailers, just like everything else, have to figure out how to deal with it. It's not an excuse. It's just a fact. And they've got to figure out how to protect themselves and still find a way to service customers. So it's an excuse, but it's real.
Hey, Bill, we just had that graphic up. You saw Starbucks, you saw Disney, you saw Nike. And, listen, at least investors are speaking with their wallets right here. Those stocks act very, very poorly. And I wouldn't put them at like the high-end consumer discretionary. I'd put them at more of an aspirational. And so you have these three buckets that you were just talking about as far as retailers. What are investors saying about them right now that maybe there is some of that higher-end discretionary, but it could be aspirational in some of those middle zones? Because to me as an investor, I find their performance very poor right now and flying in the face of some of the commentary we're hearing about wages and unemployment and the like.
Yeah, I think you guys were talking about it earlier. It's everything. So many macro issues that are disrupting what was a pretty stable consumer for a lot of years. Things like that group of companies you just mentioned would be the ones that would be impacted by, for example, the college loan repayment resumption. So I think investors look at that and they go, we don't know how that consumer is going to behave. Are they still going to go buy their $7 latte when they have to repay their loan? So maybe they won't. So we'll pass on them for now until we see what's going to happen. So I think there's a whole lot of people who just don't know what's going to happen, who are reacting to what they think the consumer will do.